Welcome to Zombie Advisor with James Knapp, the only podcast where being undead isn't an excuse for being unresponsive. This is the space where financial advisors and clients come together to break free from the old, slow-moving reactionary system. Tune in as we shake the dust off of outdated practices, dissect what really matters to today's clients, and tap into the brains of industry leaders who are actually alive, alert, and crushing it.
Welcome to Zombie Advisor, coming to you from St. Paul, Minnesota. I'm your host, James Knapp, and today we have a great show and a special guest, Tyler Rudek. But first, let's review the daily stats. Today's weather in the Twin Cities is currently 24 degrees outside, but heating up to a balmy 39. Also, on this day, in December 17, 2025, it was actually in 2024 when this happened. It was only 1 year ago today that the Dow Jones Industrial Average logged its longest losing streak in 46 years, falling for a ninth straight day, which is kind of remarkable that it's only been a year ago. And it's what we're going to talk about today is portfolio navigation, investment performance, and how to construct a portfolio with our chief investment officer. Now to introduce our guest, he's an unfortunate benefit of sitting next to me for the past 10 and a half years of his life, our chief investment officer, my good friend, Tyler Rudek. Welcome to the show.
Thank you.
Yeah. One of the things that I like to always tell people is that your first day on the job was spent in a very unique way. Do you want to tell everybody what I did to you?
Yeah, I got to golf 9 holes with James and a couple of people I'd never met before.
Yeah, which was pretty funny. Welcome to our team. Let's go golfing. Today we're going to discuss typical retail mistakes and some of the mistakes that you've seen throughout the years. Can you discuss a few off the top of your head that you've seen or anything recently?
Yeah, I think the biggest thing we run into is just very concentrated positions, home bias. You know, not all of the world's growth occurs just inside the U.S. borders, and most people left to their own devices tend to focus on what they know and invest there too.
Yeah, absolutely. It makes sense though, right? I mean, the United States is a dominant force, largest GDP in the world, fastest growing economy. Why wouldn't you just invest there, right?
Right. I guess you look at history and, these phenomena, if you want to call them that, tend to be cyclical. Whether it's active management defeating passive, or whether it's international stocks outpacing domestic or U.S. companies, small versus large. All these things go in and out of favor over time.
Correct.
And so it tends to be a better approach to own them all in weights that make sense for you and your risk tolerance and goals.
Yeah, let's talk about that. So when we design a portfolio, right?
Mhm.
Most important thing is what your goals are,
Right.
then your risk tolerance. So, and then you construct a portfolio, right?
Correct.
So, like, if we think about it, what's the most important thing in that process?
The plan.
Why is that the most important thing?
Because it's kind of the roadmap, and everything else, investments included, are important pieces of it, but they all have to be aligned in order to make the plan a success.
Yeah. Can you invest your way to being rich?
Very, very few people can. If you've created a tech company and remained the founder of it, and it gains great prominence, then maybe. But even then, you could argue you're not necessarily making your way there by investing. It's because you've built something and grown it to that point. I don't know of any people that have become financially independent solely by investing. Tends to be that you have someone with a plan who's a great saver, and they've invested uh, to outpace inflation and make their plan even more successful.
Right. I mean, typically the way you get there is through saving
Hmm.
over a long period of time and then rebalancing your portfolio on a regular basis. Let's talk about that for a second. Most people left to their own devices do what?
Do nothing. They collect or find investments they like. They might have done the front end research. They might not. In invest, set, and forget. And over time, even a well diversified portfolio at the beginning can stray to something, much more aggressive or even more conservative, depending on how markets are going, um,
Right.
because they're not making the adjustments. It doesn't have to be day to day, but has to be revisited periodically for sure.
Yeah. How often should you review your investments?
The At least annually, but I mean, we do so much more frequently,
How often do we do it?
um, almost daily, and if portfolios are in or out of alignment, we're typically making adjustments to get them back into alignment with our model portfolios.
Yeah, but how are you monitoring all that?
Technology primarily, and um, we have risk targets that guide our overall risk budget for particular clients or households, and model portfolios that align with those risk targets, and software that helps us monitor the portfolios to make sure that we're not out over our skis at any point, or if um, markets pull back, uh, we're able to trim from something that's held up better or even gone up in that environment, and buy those positions that have gone on discount now.
What do you do about monitoring a position that's underperforming?
Uh, well, we get a lot of third party research. Um, if it's an individual company, we're looking at the filings and seeking out third party information as well as our own. If it's funds, we're stacking those funds up against peer groups. If it's consistently underperforming for extended period of time without any definable reason, then we're looking for positions that we have more confidence in going forward.
When you make that change, how does that work for you and your model portfolios that you've constructed?
So just everything left equal, we're only replacing a fund. We are replacing that ticker within our trading software, and then the balance becomes, are we realizing material gains by making this switch. So
Right.
it's not just a knee jerk reaction. This fund stinks. Let's get out of it.
Right.
It's how do we both manage risk um, and get the portfolios the way we want them to, but uh, being mindful of tax bills that we're creating for our clients.
How do you do that? I mean, we have hundreds of clients. How do you mindfully do that?
Uh, Fortunately, technology helps a lot in that regard. So we have data feeding in from our custodians, record keepers, that indicates or tells us, when a particular position was bought, how much of a gain or a loss that we'd be um, realizing by selling the full position, and then we can look at the lot level to see whether, well, maybe it's not a full uh, rebalance or trade out of this position proposition. It's, let's trim what we can in a tax efficient way, uh, replace that position. We interface with accountants all the time now, um, and try to get a sense for, well, what kind of tax budget do we have? We don't want to, you know, drive somebody into a horrible April next year, and we're really mindful of that.
Yeah, it's kind of amazing. I don't think most of our listeners actually know what tax location is. So walk me through that
Sure. So if you have moderate gets thrown out a lot, it means different things to different people, but
for sure.
um, you know investment management, portfolio management really is a bell curve. Most of our clients fall in that moderate range, or risk 50 is what we term it internally, where if you're owning roughly 60% of your assets are global equities, and the remainder is combination of bonds, cash, and other, primarily income generating investments, there's ways to own those investments in a way that doesn't hamstring you so much from a tax perspective. So it's not necessarily owning that 60/40 portfolio in each and every client account. So if they have a portfolio that consists of multiple accounts, owning the right kinds of investments in the right kinds of accounts. So for income generating investments like bonds or fixed income, typically means we have a preference for owning those in uh, accounts like traditional IRAs or 401ks, where
Mhm.
the interest that you're generating on those investments doesn't receive the annual haircut that you get from taxes. So if you have a bond that's yielding 5% and you own it in your taxable account, well, all of that interest is treated as taxable income to you in that year that you've earned it. If you've shifted that investment over to your traditional IRA or your 401k now, this exact same investment, 5% remains 5%, whereas in your taxable account, it might look more like 3% after taxes.
Yeah, tax equivalent yield, right?
Correct.
Yeah.
Hold up. Just a quick pause in the zombie action. You're listening to Zombie Advisor, and I'm so pumped you're here. Got a question? Want to challenge something I said? Head over to boyumwa.com or hit the show notes to find me. Don't be shy. I'm not actually undead.
When you're at a party, I'm going to switch gears here a little bit because I always think it's funny. People find out that you're investments. How often is it they walk up to you and say, "Have you heard about this investment? And should I buy it or not?"
Yeah, it's fairly often. That and cryptocurrencies has been kind of the topic of the last few years. Uh, you know, what allocation do you have to um, whatever crypto coin is popular?
Yeah. What's the most recent one that you've heard?
I mean, it's Bitcoin is dominating the day, and I bought it back in 2020, and um, look how well it's done. And the problem becomes when you exit it. Like, how do you time it well? Um, how much taxes are you paying as a result of your fortunes? And that's not often discussed.
You mean you have to pay taxes on crypto coins?
I think so.
Like legally, you're supposed to, yes. Um, when you think about your job and all the facets of it that you get to deal with, my favorite line that you have is, "We don't gamble with the rent money." What's that mean to you?
So for most of our clients, well, all of them, we're seeking this long-term goal of being financially independent,
Right.
and most of the time that means you've converted um, your life from being a worker, you're W-2 or 1099 compensated. You have this monthly paycheck that you can count upon. Well, now that shifts in retirement, and that's a meaningful shift psychologically for clients. And we like to recreate a paycheck rather than send you a lump sum at the beginning of the year and say, good luck stretching it out.
Right.
Um, we are more inclined to, okay, what's your budget? We'll send you that and more on a monthly basis so that you have this monthly income or stipend that you can more easily budget your life, and it feels better from a client perspective as well. So what not gambling with the rent money means to me is if the market falls 20% over the course of a month like it did earlier this year, we're not faced or hampered with deciding, well, what do we trim from or what do we sell from in order to meet John Smith's next paycheck. And instead, we're keeping multiple months of those paychecks set aside in the accounts or portfolio um, to be there in the darkest days.
Yeah, I hear you say it a lot, and clients actually start to resonate on that. I always think that when you retire, you're so used to working, getting a paycheck every 2 weeks or every month, however you get paid. It's an easy way to budget your life,
Mhm.
right? And so, let's talk about Liberation Day because you mentioned 20% pullback, right?
Right.
It's not like when I looked up the market and remembered December 17th of 2024, I had forgotten about that until
Mhm.
I just did it. It happens so frequently that we have pullbacks in the market that I don't really pay attention to it anymore. And
Right.
that's probably sad on my part, but that's why I have you.
There are days when I don't look at the market's performance either.
Yeah. It is kind of remarkable though when you think back of uh one of the things I did to you, which I completely regret, is under COVID. We switched from one portfolio navigation tool to another at the middle of the COVID. Could you describe that to me a little bit?
Yeah, it was that was mean of you to have predicted COVID and aligned it with our changeover in portfolio accounting software. Um, I recall going to Omaha for the training for this new program, while the six patient zeros from the United States were also headed to Omaha at the same time
Yes.
because that's where they were being quarantined.
Being quarantined.
And after my 3-day training, came back, and then very shortly thereafter, we were sequestered in our homes, and we were managing the changeover between systems from home instead of at the office.
It's kind of remarkable when you look back at it.
Hmm.
When you think about the future of investing, what do you see?
Well, I think in a lot of ways, the publicly traded investments are becoming further commoditized. We're seeing it all the time, where first it was like race to zero, and pushing fees down as low as possible, and I mentioned before active versus passive debate, and whether um, any of your funds are meant to be actively managed. I believe that it's kind of a yes and
Mm-hmm.
proposition, but now more and more funds are moving from mutual funds to ETFs, where they're more easily tracked, and with technology, it's becoming easier for traders to replicate those strategies
Mm-hmm.
outside of those wrappers even.
Mm-hmm.
So I think it continues to be important to manage one's risk, and the way we're doing it today is via liquid alternatives, and with alternative investments that people just don't have access to on their own.
Mm-hmm.
And all in an effort to move portfolios up and to the left, less standard deviation or risk, hopefully greater realized returns over long-term stretches. You look back historically, that's tended to happen. Anything can happen over the course of a year or two, but um, we think that's kind of the way forward, is giving more people access to more assets, and then managing taxes is always the big elephant in the room.
Absolutely. There's two things I hear our clients talk about a lot.
Mm.
One is political risk, and the other one is, are we in a bubble? So you say it's the snake that bites you don't see, right?
Right.
What's that mean?
Well, I think if you at home are sitting on your couch and pointing out, well, that's going to lead us to ultimate demise, it's probably been thought of, and probably been thought of months, if not over a year
Right.
in advance, and is probably already priced into public markets for sure, and probably private markets as well.
Yeah. When you think about that, often every year now, I see you going to the JP Morgan conference, and Jamie Dimon will walk into the room. So you're seeing probably the largest bank in the world and talking to them on a regular basis. That's
Mm.
when I think about, I don't think our average retail investor actually understands how many people are working in this industry, how smart the industry actually is and sophisticated it's become.
Mhm.
And so when you get boots on the ground and you're in New York City, are you often overwhelmed, or are you just like, wow, this is great and I can't wait to go back? What is that like for you?
For me, it's great. I can't wait to go back because you're having this opportunity to listen to so many thought leaders, inside and outside of JP Morgan or whoever's hosting, um, whether it be markets related or just life, how to improve your life, because life's not all markets, and um, so that it's something I look forward to most years. Yeah.
Who was the speaker this year? Was it the guy that did Outlive? Was that the year?
Yes. So he spoke, an artificial intelligence expert. Um, there's always professional athletes involved, and JP Morgan private clients. This year we had Jamie Dimon as well.
Wasn't it A-Rod?
No, that was 2 years ago. Mark Lurie was there this
Oh
year.
yeah,
This past-
Larry was there instead.
Yep,
All comes back to my Timberwolves. That's
that's
all I
right.
gotta say. Um, any last words that you would like to give as advice to our listeners on how to invest for the long term?
Yeah, I think first and foremost, identify a risk target, and then you got to stack yourself up against meaningful benchmarks. The vast majority of people are looking at their portfolio relative to an all stock portfolio, and it just doesn't make sense to do. And then revisit it periodically and make sure that you're still in line with that risk target years from now.
Yeah, and save
Mhm.
aggressively, right?
Exactly.
Maybe if you have a long-term risk target, you can go more aggressive into all equities, and if you have a shorter-term risk target, maybe think about diversifying in more heavily weighted areas like bonds or real estate or whatever, right?
Exactly.
Well, thank you to our special guest, Tyler, for a great conversation. I hope you got as much out of it as I did. Thank you very much. Remember to find us on YouTube or LinkedIn, also Apple Podcasts, Spotify, and all your major podcast platforms. Please like and subscribe so you don't miss a thing. As always, be on the lookout for zombies in every service industry. Have a great day.
Thanks for listening to the Zombie Advisor with James Knapp. Don't forget to hit that follow button so you never miss an episode. Want to learn more? Visit us at boyumwa.com, BOYUMWA.com, or give us a call at 651-289-6444. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Boyum Wealth Architects. The content has been made available for informational and educational purposes only and is not intended as a substitute for professional investing advice. Always consult your financial advisor or other qualified service providers with any questions you may have regarding your personal investment planning.